A month or so ago, I think it was longer than a month or so, but I made a video on how to make 10%, and there was another video along with that on basically the 10 things you need to know, in order to trade. Those are very much relevant, right? If you understand those things, then you know, actually coming up with either a strategy or trading your own concepts is not it's not hard, right? Um, I think when you first try to create a strategy, it's very difficult. A lot of the time, we don't know the difference between a strategy and a concept. I guess that's the most crucial thing. But once you understand, the concept you want to trade, and I think putting together a strategy around it is fairly simple. We don't ever have to recreate the wheel. We either like short-term trading or we like longer-term trading. But it's up to individuals to come up with what they prefer to do, and you can take advantage of any of those, right? And there are a lot of short-term traders you can find on the internet, man, like on Instagram or your social media. You see them all the time, like Charlene and MPZ Trading, and there are a number of people that drop down because what most of them do, uh, and what I've kind of started doing is stacking your positions, right? Uh, it's a higher risk method, but I mean, if you understand how to trade order blocks, and at that point you have to wait to get tapped in. If you understand what I mean by getting tapped in, but if you trade like that, you want to make sure you trade from an order block and you get tapped in. And most of those guys are trading from the 15-minute order block and they get tapped in on the 5-minute, and they're super over leveraged and they take the trade for a few pips at a time. But that's neither here nor there. I just kind of wanted to make sure everybody understood, what we're trying to do. Because if you understand what we're trying to do, then it's only a matter of time before you figure out or hone in on a strategy that works for you, especially if you don't like the 100 pip stop loss and all that other stuff, right? Um, I think everybody at this point, kind of knows what they like. So going forward, it's really just honing in on what you need as an individual, what you need to lock in on, whether it's market structure on the time frame that you want to trade, or how to correlate that time frame with the higher time frames. And those are more time oriented things. Like if you don't spend time on the charts, it's always going to be hard to understand where you are in the trade. And just going to pull up the chart real fast. Let's look at gold from last week. As you can see, gold was a bullish order block. We expected to take it down, right? In this case, gold went all the way down, tapped in, and started buying up, right? It's kind of what you expect to see at an order block, and it kind of just played out perfectly. A lot. I know it's a lot of news, but if you had traded gold down, obviously you'd have made a killing, and then you could have traded it back up, and made a killing on the way back up. But if you just traded the concept of trading it down, there's your 4-hour order block at 1 in the morning on New York time. I'm sorry, London time frame. It is 1 a.m. New York time, but if you traded London session, you could have got your entry. You'd have just held your entry. It would have hit your TP Tuesday New York time by 9 a.m. You could have held it until basically Tuesday night. But if you just traded that 4-hour order block, you'd have been good to go. Obviously, the news hit and price shot up. News was huge this week because at the first of the week, it looked like, by all indications for those job reports and whatnot, it looked like the Fed was going to have to take a 50 basis point hike here in the coming month. But NFP showed the opposite, right? It showed that the wages didn't increase and unemployment is a little bit higher. So now I think that the Fed is probably more comfortable still going with the 25 basis point increase. And that's why you saw that reversal, right? That's why you see gold pushing down, because everybody thought that we were going to have this massive, dollar increase. And then you see NFP gold shoots up because the numbers didn't support the earlier numbers, okay? And if you understood that, you could have taken advantage of both sides of the trade. Okay, let's talk about the structure piece, right? You can see we just broke this high, right? So from a structure standpoint, you want to see price pull back to this area, right? And then push higher. Or if you want to simplify that, you see this huge daily candle, right? You want to see price pull back, a 50% retracement, and push higher. This is the same concept, okay? The same concept that we trade on the weekly chart, right? And if you're on the call Tuesday afternoon, I was explaining to people on Tuesday, and this is what brought the concept into question, because we always talk about trading the weekly candle at the beginning of the week. But what I was telling people on Tuesday is you can do the daily candle the same way we do the weekly candle. The concept is exactly the same. You're just trading the pullback to the candle, and then the candle you expect to push the same direction, that it's going to push that week. So the concept is the same. If you understand the concept, you can trade any candle, whether it's the daily, the 4-hour, the 1 hour, the weekly. All right. You can do it the same. So it should not confuse you. And you should understand what we're doing when I fib the candle. You can understand why I'm fibbing the candle, what I expect from the candle, and you can understand where I'm trading it to. Now, just because we expect it to make the move doesn't necessarily mean it's going to always trade and hit the 50% marker. It doesn't always happen, which is why, listen, guys, which is why it's more risky to trade this concept on the lower time frames. I'm going to say that one more time. It's more risky to trade this concept on the lower time frames, right? Here's why. If I'm trading this concept on the weekly time frame, which I do every week, right? And if it doesn't go to my target, which is that 50% mark, right? I have plenty of time to change directions with the move, right? Probably a couple of days to change directions and recoup any loss if I have a loss. That's harder to do. It's exponentially harder to do on the lower time frames. If you're trading a 1 hour candle and it doesn't retrace 50%, you have a couple minutes to understand that, hey, this is not going to where I thought it was going to go. It's going to reverse and keep going. And you understand that you have a couple of minutes because this is a 1 hour candle instead of a 1 day candle, or instead of a 1 week candle, right? So that change in direction and that turnaround is going to happen on the lower time frames. So it's going to be a couple minutes that you have to change directions and go with the flow, versus on the weekly chart, you probably have a couple of days or at least a few 4 hour candles to see a change, right? So in my opinion, it's more safe and it's more easily identifiable when a trade goes against you on the higher time frame, and it gives you an opportunity to make some adjustments and corrections and still earn a profit. Is everybody following me? I should say, who is not following me? Drop a 2 in the chat if I need to explain that further. Please. I think more and more people are.
Sorry, Todd. I came in late. If you could say it one more time, I'll appreciate it. I'm sorry.
Okay, no problem. So I'm explaining concepts, right? The concepts that we're trading. Last week, we wanted to trade gold. We wanted to trade gold back into the zone here, right? We fibbed this weekly candle. We expected gold to pull back and then go up. We dropped down to the 4 hour at 1 a.m. New York time, your time, Kat. Gold gave us that 4 hour order block saying that it's going to sell. We could have hopped in the trade. For those of you who only take the trade after the moving averages, here you go. Here's 2 rejections at the moving average. You'd have been in the trade too. So here's your 4 hour order block saying that the trade is pushing down. There's your entry. For those of you who only trade after the moving average, here's your entry. The trade pushes down. It hits TP, right? It does a U-turn and it pushes back up. Okay. This is a weekly candle. So let's just say it pushed down and didn't quite hit our TP. It turned directions here and it crossed over your moving average right here. You have plenty of time on this weekly candle to say, hey, it's not going to reach my TP. I need to switch and I need to start buying this thing in order to make, you know, my whatever, 10% or my whatever you're trying to make, 7%, 5%. To make my percentage, I need to turn and start buying this thing. This is a weekly candle, so it allows you plenty of time to make those adjustments. If you trade this same concept, the same pullback concept on a lower time frame, let's say you're trading this concept on this 4 hour candle, and you fib this 4 hour candle, and you expected the sell price to your golden zone right here. Price only pulled back to 23%, and then it pushed up. So you didn't have as much time to make an adjustment, to change directions, because you're trading a lower time frame. So what I was saying is, if you trade the same concept that we trade with this weekly candle, if you trade it on the lower time frames, you don't have as much time to make adjustments if it doesn't pull back to where you think it's going to pull back. And this is the reason why I like trading this concept on a higher time frame candle, right? On a weekly candle, on a monthly candle, on a daily candle. These candles give me a better opportunity to make adjustments if it doesn't quite reach where I think it's going. Okay. That's all I was trying to explain. Does that make sense?
Yes.
Okay. Now there are reasons that we can all expect for candles not to do a sufficient pullback, right? And most of the time, those reasons are going to be news related, right? And during a news event, we expect to see these big candles that don't pull back, right? Because the news pushes the candles a certain direction. And we expect that later on, at some point, price will come back, and close this imbalance. That's all it is, the imbalance. So during the news events, we shouldn't expect to see full retracements. That means this concept should not be traded on those lower time frames, especially during or right after news events. Okay? Y'all tracking? That's very important. Where would my stop be? Okay. This is a good question, or a question that I get all the time. And I like to consider this question a hot potato question, because it depends on you as a trader, right? This is the primary example of why I created God's plan, right? Because people don't really understand where they would put a stop. So let's just go back and let's just talk about it. Throw this replay mode on. Don't tell ICT we're using replay. I want to fib this candle. This is exactly what we did last week. Our golden zone is here, right? We're going to drop down. I'm just going to delete this fib because I just pulled it off anyway. All right. So this is exactly what we saw last week, right? Now, if you notice last week, this is a 4-hour order block that this price is in, right? There's another order block that, Kim probably doesn't call an order block. It's a doji order block right here, right? So you have 2 back-to-back order blocks, right? So this is what I would say. Depending on you as a trader, if you trust this first order block, which is about 48 pips, then that's where your stop loss should go. If you want to go higher, this is 152 pips. I don't suggest having 152 pip stop loss. So you can wait. And here's what I mean by wait. I'm pretty confident the price is going to turn around at one in between this area, right? When this market opens up on Sunday, I expect price to push down. So I'm going to wait. I don't want to do the 152 pip stop loss. Either I'm going to do this 48 pip stop loss, which I would do, because especially since I use a hedge, even if it picked up my hedge, I'm cool. But I know a lot of you guys don't like using hedges. So what I would say is just wait. Let the market do what it's going to do. You can look at it on the 1 hour, because the first hour we can't trade anyway. So at that first hour, when the market opened up, oh, it started selling, right? So you could have gotten in right here, and then put your stop loss, your 100 pips up. This is 64. We're just going to say right here. This would have been your stop as your God's plan, your 100 pip stop loss, right? Or you could have trusted this 4-hour order block and had your stop loss here. It doesn't matter. It really, depends on what style of trader you are. Or you could have just waited until you got a 4-hour order block, right? There's your 4-hour order block. Right here. You could have put your stop loss, you know, anywhere in here. Because there's your 4-hour order block. You could have had your stop loss right here on this wick. You could have got your entry in this candle or this candle. Either one of them are fine. Any of these, you can see any of these stop losses would have been perfectly fine. Any of them. The initial one, you know, whether you got in on this 4-hour order block, they're all great. All those stop losses are great. The only difference is how much money would you have made, right? But it's important that we're talking about how much money you would have made. Everybody would have made money. Everybody would have made money, right? There were 1,000 different excuses of why people didn't want to take the trade or didn't take the trade. You know, I don't trade, go, okay, you know, whatever. But my point is, any of these stop losses you could have used, right? You could have used this higher one. You could have used this 4-hour one. You could have used that one in the middle after it gave you that initial push. They all would have been great, right? You know, really my goal here is to make people understand that instead of us trying to worry about sniper entries at this stage of the game, you should worry about getting in the winner. It's a freaking winner. You're going to win. Get in the dadgun trade. So, you know, that's the most important thing. If you're in the trade, you're going to win. So you'd have gotten that trade, and the trade just ran, man. I think this is this will probably be the most difficult part to understand, because most people are drilled with you know, trying to get the tightest stop loss. That's cute, it really is. But you know, it's a lot of people that get a very tight stop loss and get stopped out, and then the trade goes exactly where they thought it was going to go. So what I would suggest is open up your stop loss a little bit, give you a trade room to run, and then just, you know, you can still collect until you figure out what works best for you, you know, especially when you start understanding where you should look to see what order blocks or what imbalances needs to be filled, right? Is everybody tracking? Mm-hmm. So everybody understands the concept. Does anybody need further explanations? Bueller, anyone? Yo, now's the time, man. I mean,
Okay, I have a quick question. If you use the moving averages, where would your entry be?
if I use the moving averages, okay. First of all, what is your understanding of the moving averages?
I feel like from my knowledge, I would say the moving at. Okay, my kids are being loud, but so from my understanding, we use the moving averages to help guide for like the direction. You can also use it for entry. And
Correct.
so,
So where would you enter? You have a rejection here, right?
yeah.
You have a rejection here. I think.
So I would probably enter on that candle probably before the green candle, honestly.
On this candle?
Yeah.
Well, exactly. I mean, you have a, in my opinion, then you have a bearish order block. So you have two bearish order blocks in a row. You know, I think this is a good entry. But let's just say you didn't want to enter here. You could have waited until you got this candle right here, this rejection. You could have entered here. It would have still pushed up a little bit, but it would have dropped. So I don't think that there's a, like, either one of these candles are fine, in my opinion, right? I think we have to pay attention to everything on the chart, though. You have two bearish order blocks back to back, and we're already expecting it to sell. I think that's a pretty safe sign that you're going to get your sell, and hopefully everybody notices this type of stuff on the chart, right? These are back to back 4-hour order blocks in your direction. In my opinion, I mean, you enter right there.
Right. Thank you. That's helpful. I do like to use the moving averages for, like, if I was to trade gold or like an index, just because I really don't trade those very often.
Okay, I would just tell y'all that like everybody else. I mean, everything. If it's true that that you can trade any instrument if you understand how to read a chart, then it doesn't matter if you're trading gold, Bitcoin, US 30. I mean, they're going to respect structure, right? And outside of some crazy, event happening, like banks collapsing, planes running into towers and stuff, you're going to get the move, and it's going to respect those order blocks. Anybody else? Now is the time. Brad. Okay. All right. I'm about to set up.
I got a question, Todd.
What's up, Will?
So when you're doing God's plan, we're gonna go over the prayers we think that's gonna happen today, right?
Somebody will. I'm not gonna pick the pair, but somebody will.
Okay.
But yeah, we'll talk about it. We'll talk about it in great depth if we need to.
All right. And are these typically like London moves?
All right.
Most of the time, I'm assuming.
Let's talk about that. So no, I'm not going to say they're typically London moves, right? Sometimes the pair will move right when the market opens. It'll take off, right? But what does happen a lot of the time is the market opens up, it makes its move, and then on London session, you get that retracement. See that? Or that liquidity grab. So if you pay attention to this, the market opened Sunday right here, and gold just sank. But when London came around, it went way up here and grabbed the liquidity. So everybody who was in this trade and had a stop loss here would have got taken out. You see that? If the market had opened and you would put your stop loss right here above this old high from last week, then on London session, they would have liquidated you and then kept running the trade in your direction. This is why I try to tell people this tight stop loss game that y'all play is crazy. just because, you know, you want the higher lot size or whatever. You have to understand the overall goal is to get these 100 pips or however many pips that's available to you to this golden zone. I just try to preach 100 so everybody won't be greedy. But if you open up your stop loss because you understand the concept of the trade the entire retracement, it doesn't matter that they grab liquidity on London, right? So some people would say, hey man, this is a London session trade because it took the liquidity during the London session. But I would tell you, it doesn't matter if you could have, as soon as that 1 hour went away, you could have entered this trade and your stop loss would have been way up here somewhere. And what happens on London session, who cares? You know, they grab liquidity, you would have been in a little drawdown, but most people are going to be asleep during that time anyway. And then the trade runs, right? So you can look at it as a London session trade. If you trade the London session and you're up most of the time, you know, like I am, you'll see this and you can get in when that happens, right? But this shouldn't scare you at this point. It shouldn't scare you that price pushes up past the entry that you got in on the Asian session, right? Most of us in the United States are going to be asleep during the London session, you know, especially if you got to work on Monday morning. But if you place your stop loss right, you know, and you use a proper lot size, you don't worry about that liquidity grab. Does that make sense?
Yeah, it made perfect sense. I was just curious when the move happen. So we typically place this trade Sunday night for guys when the market first opens.
Well, yeah, you can trade anytime on Sunday. Whenever you get so if your entry is this 4 hour order block, you couldn't have entered this trade until London session. If you trust, you know, that this is pushing down and you're on a lower time frame, let's say the 2 hour, and you got your order block on the 2 hour earlier that afternoon, whatever the case may be, then you would have entered, you know, then like, let's say this is Sunday, this first hour or this first 2 hour, you could have entered the trade right here. See that? Now you're going to be in drawdown and the London session is going to go your way. So your entry could have been after the 1700 candle. You could have entered, you know, 1701, right? Or whatever. This says 1901. Let's just say 1901. 7 o'clock, my time would have been what, 9 o'clock East Coast time? 9 p.m. you could have entered this trade. You'd have went to sleep and you would have woke up, you know, in profit.
How many pips did that go wind up going anyway on that sell off?
Bruh. it would a bunch of it. Let me see. 435 pips.
You made you 20%. You ain't got to trade for the month.
Yeah, I mean, you know, this paid very well, right? If you're, you know, listen, guys, it does grab liquidity, but I'm just trying to tell you, who cares? It does grab liquidity, but it's not important that it grabs liquidity if your stop loss is in the proper spot. If you're awake during London, that's cool. You can wait for that. You can wait for it if you're awake. This, I mean, it happens. I want to say 99% of the time, it's going to grab liquidity. If you're awake, that's cool. You can get your entry right here. But in the grand scheme of things, it's not important. You know, if you're trading, I mean, listen.
How many pips is that? I mean, how many pips would be like 80 or 100 pips from your entry? I mean, can you put that thing on there?
Sure.
Please.
This was Sunday.
Oh, so you have ample room.
Yeah, listen, I mean, whenever.
No, I just couldn't measure it with my eyes on this particular
Whenever I
one.
put this trade idea out, I said, man, I mean, this is going to run to the zone. I mean, you got plenty, you know, I mean.
Oh, this is 90, look, like 94 converting.
This is right here is 106 pips.
Mm-hmm. And then a stop loss, you just convert it.
Yeah,
Just
this
convert
is
it to
this
like
is the
4.
yeah, basically
Mhm.
94. So it's not 100% accurate because to me
Right, right, right. Mm-hmm.
this is a picture this is all the picture you needed to see.
Mm-hmm.
If you had just did 100 and 100, you would have TP on this counter right here Monday at 1300. But if you had trusted it, I mean, all signs were this was going to keep pushing down.
Wonderful.
Any other questions? Where do I put the ideas? AL is new on this call right here. Actually, when we go into the market analysis part, that's when I will say, or in the past, that's when I would say, this is the trade that I'm taking. I'm not going to do that today because I'm going to let other people do it. But the concept is the exact same. TT catches these trades every week. She calls them out every week. All I do, and let me go over this real fast. This is very easy at this point. The only thing that I look for when I fib this candle right here, right? I'm fibbing a whole week of action from last week, right? I want to make sure that when this thing pulls back to the golden zone, I want to make sure that there's plenty of room for me to catch 100 pips. When I look at this pullback to the golden zone, it's 249 pips. I'm very confident that there will be 100 pips available to me on the pullback. Even if it doesn't make it all the way to the golden zone, I believe it's going to pull back 100 pips. Okay, that's how I choose. And when I look at this candle, if you can see, there's relatively no retracement. So I'm confident that we're going to push down. Okay.
And so, Ty, you just looking for an order block on a bearish order block on a lower time frame to get in to get that retracement, correct?
Me personally, no, that's not what I'm looking for. Here's what I'm looking for. If I drop down, I'm going to look on this side of the chart to say, hey, man, where does price need to push up to before it starts pushing back down? And in this case, we're in an order block, right? In this case, we're in this 4-hour order block. So I'm pretty confident that this 4-hour order block is going to stop and push us down, right? And if this one doesn't stop us, there's a 4-hour order block. See this huge wick right here?
Mm-hmm.
So there's 2 back-to-back 4-hour order blocks. I'm very confident that we're going to push down. So me personally, I mean, I'm hopping in this trade as soon as the spreads drop, I'm in there, right?
But isn't that what I just said though? I don't know if I'm saying slow, but
Well, you said as soon as you get a 4-hour order block.
I don't mean a 4 hour. I'm just saying you're looking to see, you're looking for order block to potentially push you back down.
Right, either that or let's say right, but let's say
imbalance. I'm just talking about one of those.
Yes.
Go ahead.
Yes. Let's say price was here and maybe you thought price was going to come up to this imbalance because a lot of times that's what we're going to have. There's an imbalance right here. Price is right here. Sometimes price is going to go up, touch this imbalance before it sells. So you have to make a decision as a trader on do you want to be patient and wait to see if it's going to push up first, or do you want to take this initial entry? And if it pushes up, you either have to get in the hedge, or you have to make sure that this push up won't violate that 100 pip stop loss you have. That makes sense?
I got you. Yeah, it makes perfect sense.
Yeah. But even last week, I said we were in this 4-hour order block. So I was very confident that this thing was going to push back. And even if this 4-hour order block didn't stop it, I knew this one would. The only difference is this is 152 pips to the top. But if on the market open, when the market opened in that first 1-hour candle that pushed down, man, I mean, that was a sign to me that we were headed down. Any other questions? Bruh. I didn't need to set a limit order. I was watching it. I mean, you can set a limit order. You know, your entry technique needs to be your entry technique. And here's what I mean by that. You can set a limit order, especially if you see an imbalance here and you think price is going to go up and fill this imbalance, then maybe you set a sell limit. Maybe you set a sell limit here. The price goes up and taps into your sell limit and sells, right? If your entry is a break and retest and you're on the charts and it breaks and it retests whatever time frame, the 1 hour, the 2 hour, the 15-minute, right? If you're down here on the 1 hour and you want to see price break this low right here, and then come back and touch that low, then that's what you wait on. I can't tell you your entry method, but whatever it is, I suggest that's the method that you stick to. If your entry method is supply and demand, then you probably would have gotten in this trade based off it hitting this area of supply, right? It's in this area of supply. So as soon as you would have seen it push down, that's your entry. Y'all tracking it?
It's making perfect sense, Ty.
All righty. All right. Keep it short and sweet. That was 50 minutes. That's really what I wanted to talk about today. So if y'all need one-on-one assistance, hit a brother up. The fib numbers, the fib numbers, the fib numbers.
$250. No, I'm just playing.
All right, let's talk about the fib numbers. I got my fib numbers from J Take Profit. Screenshot it if you need it. This is the numbers that I use. Some of y'all get thrown out because I don't use a zero. Okay, I'd be remiss if I didn't mention this. Some of y'all aren't going to use Fibonacci, right? Some of y'all just want to use structure, market structure. That's fine. I like to use tools. So yeah, listen, this God's plan strategy, I like to use tools. You know, I use the Fibonacci. Sometimes I use moving averages. You know, at this point, I've traded this for so long that it doesn't matter to me. You know, I can use whatever. But for those of you who are just coming here and looking, you know, use whatever available tools you want to. You can use naked, you know, you don't have to use any tools. You can just use structure on the chart. And where you can just trade the breaks and the retest, if that's how you trade it. You can trade supply and demand. But the tools are there. I want people to understand that the tools are there, and obviously you can use those tools. The question was asked, can you use guys playing on slow movement stuff? Yeah, use it on everything. I just, as long as price is going to give me that 100 pip move, I'm going to use it until the wheels fall off, right? Because me personally, I'm looking for 100 pips. And this coming week, you'll see that there are plenty of opportunities for us to take advantage of pairs that have moved, you know, all those pips. Okay. The moving averages. I use two moving averages, just regular moving average, simple moving average. One is a 9 and one is a 13. Now, what you probably need to do is go look at the moving average video. The 9 period moving average is going to have a green line, right? The 13 period moving average is going to have a red line. That's the only difference. One is a 9, one is a 13. The 9 is a green, the 13 is red, okay? Now, I should just say the smaller number is the green number. The larger number is the red number, because you can always adjust these moving averages as you need to, because you want them to run across the top of the candles on a downtrend, and you want them to run across the bottom of the candles on an uptrend. And if you look at that moving average video, or if you go listen to Oliver Velez, you'll understand what I'm talking about, right? So if you get moving averages that run through the middle of your range like this, then that means they need adjusting, right? Every trend is not going to be the same, right? It's not going to fall as hard, or it's not going to go up as fast. And you might need to adjust your moving average. You don't want your moving average to run through the middle of your range, right? Your moving average is no good to you like this, or it just means that your pair is consolidating, right? And in this case, it just meant that the pair is consolidating. Then you get the uptrend and the moving average falls right under it. Then you get a down move and the moving average goes across the top, okay? But there's moving average videos on the YouTube page. Any other questions? All right, great people. That's the end of the weekly meeting, and we'll get into the analysis here shortly.